Welcome, friends, to today's episode of our podcast. If you've ever wondered why some people build lasting wealth while others struggle, even when they have the same knowledge or opportunities, then you're in for something truly eye-opening. Today, we're exploring one of the most powerful and talked about books on money and success, The Psychology of Money by Morgan Housel. Morgan Housel begins by showing that when it comes to money, nobody is truly crazy. People make financial decisions not in spreadsheets, but in the real world, based on their own unique life experiences. For example, someone who grew up during the Great Depression may see money as something fragile, always at risk of disappearing. Meanwhile, someone who grew up in a booming economy may feel more comfortable taking risks with investments. What looks irrational from the outside often makes perfect sense within someone else's life story. Everyone carries their own financial scar tissue and worldview, and this deeply shapes their decisions. Success is never just about intelligence, effort, or skill. Sometimes it's about being in the right place at the right time. He uses Bill Gates as an example. Gates was brilliant, yes, but he also had access to one of the only high school computers in the country in the 1970s, which gave him a once-in-a-lifetime advantage. On the other side of the coin, risk can destroy even the smartest and hardest working people. A single bad decision, or even bad timing, can undo years of effort. Be humble about your successes, empathetic about other people's failures, and always remember that luck and risk are two sides of the same coin. Luck and risk play bigger roles than we often admit. True wealth isn't about constant accumulation. It's about knowing when you already have enough. Greed can destroy even the wealthiest. Learn to define enough. Housel highlights that Warren Buffett made over 90% of his fortune after the age of 65, not because he suddenly became a better investor, but because he had been investing consistently for decades. The magic of compounding lies not in getting the highest returns, but in earning reasonable returns consistently over long periods of time. Even small growth rates, if allowed to run long enough, become massive. Wealth is built slowly through patience and time, not through chasing quick wins. Housel makes an important distinction. Getting rich and staying rich are two very different skills. Getting wealthy often requires risk-taking, optimism, and bold moves. Entrepreneurs and investors usually take big chances to build their fortunes, but staying wealthy demands the opposite: humility, frugality, and fear of losing what you already have. He emphasizes the role of survival mindset. Wealth is useless if you can't hold on to it. Many people fail not because they never made money, but because they couldn't preserve it during downturns, recessions, or market crashes. Avoid catastrophic risks. Prioritize survival over heroics. Wealth is a marathon, not a sprint. In investing, most of a portfolio's growth often comes from just a few home run stocks. In business, a few breakthrough ideas or products can outweigh dozens of failed attempts. Housel points out that Warren Buffett's success is not because every investment was brilliant. It's because a handful of them, like Coca-Cola and Apple, became massive winners. Don't be discouraged by failure. Embrace the idea that most attempts won't pay off, but the few that do will more than compensate. The highest form of wealth is freedom, the ability to control your time and make choices without being forced by money. True wealth isn't just about buying luxury goods. It's about waking up every morning and deciding how you want to spend your day. People often underestimate how valuable autonomy is compared to material possessions. He shares that many wealthy people still feel trapped by obligations, by status, or by the need to maintain appearances. But those who have time freedom experience the deepest satisfaction. Money is a tool to buy freedom, not just stuff. Control of your time is the ultimate return on wealth. We assume that buying flashy things makes people admire us, but in reality, nobody is impressed by your possessions in the way you think. When someone sees you driving a luxury car, they don't think, wow, that person is amazing. Instead, they think, I would look cool if I had that car. So the admiration goes to the object, not the owner. Housel calls this the man in the car paradox. People chase material goods for social validation, but the validation rarely comes. If your goal is respect and admiration, you're more likely to earn it through humility, kindness, and authenticity, not through possessions. True wealth is invisible. The cars not bought, the clothes not purchased, the vacations not taken. These unspent dollars represent real wealth. People often confuse being rich, spending a lot, with being wealthy, having assets and financial security. He explains that financial independence is built by what you save and invest, not what you show off. The irony is that when you see someone spending extravagantly, it's proof they're decreasing their wealth, not increasing it. Wealth is built quietly, through restraint, discipline, and unseen choices, not through display. Saving money is the most powerful financial tool you have. You don't need a high income to build wealth. You need the ability to save. Saving provides flexibility, resilience, and options. It allows you to handle emergencies, seize opportunities, and sleep peacefully at night. He emphasizes that saving isn't about being cheap, it's about valuing freedom over consumption. Every dollar saved is a vote for your future independence. Building wealth is less about income level and more about your ability to consistently save. Housel challenges the idea that financial decisions must be perfectly rational. He says, it's better to be reasonable than rational. Purely rational investing might tell you to ignore market crashes and hold tight. But emotionally, many people panic and sell. Instead of chasing perfect logic, you should adopt strategies you can stick with, even in stressful times. For example, holding some cash, even if inflation erodes it, might be irrational, but it provides peace of mind and flexibility. Paying off debt quickly might not be mathematically optimal, but it reduces stress and improves behavior. The best financial plan is the one you can stick with long term. Reasonable beats rational. The world is shaped by events no one saw coming: wars, pandemics, market crashes, technological breakthroughs. Yet most financial plans assume we can predict the future with precision. Housel argues we must embrace uncertainty. Don't anchor your life to precise forecasts. Build flexibility into your financial plan so you can adapt when surprises come. Expect the unexpected. Success in money isn't about predicting the future. It's about preparing for a range of possibilities. Housel stresses the importance of margin of safety in financial decisions. No matter how confident you are in your plan, life throws curveballs: job loss, health problems, recessions, or unexpected expenses. Having extra cash, conservative assumptions, and backup plans protect you when things don't go as expected. Always plan for the possibility that you might be wrong. Build room for error. It's the difference between financial survival and disaster. Our goals, values, and desires evolve over time. What you want at 25 may be completely different at 45. Locking yourself into rigid financial goals ignores the fact that you, the person, will change. Housel emphasizes humility. Don't assume your current desires are permanent. Plan flexibly so your money can support your future self, not just your present self. Avoid overcommitting to a single version of the future. Stay flexible because your priorities will evolve. Everything has a price, even if you don't see it up front. The cost of stock market returns is volatility and uncertainty. The cost of wealth is often discipline, patience, and sacrifice. Most people want rewards without paying the price. Smooth investing, fast results, no stress. But that's not how it works. If you want big long-term gains, you must be willing to endure short-term pain. Recognize and accept the hidden costs of success. Pay the price willingly. It's the ticket to wealth. A day trader chasing quick profits and a retiree preserving savings are not playing the same game, even if they're in the same market. Problems arise when people adopt strategies that don't match their own goals, like copying others' investments without understanding their context. Housel argues that your financial choices should be based on your time horizon, your risk tolerance, and your goals, not on what others are doing. Stay focused on your own game. Don't get distracted by other people's moves. They're playing for different reasons. Housel explains why pessimism often sounds smarter than optimism. Negative predictions grab attention because losses feel more painful than gains feel rewarding. In finance, this leads people to overestimate risks, obsess over market crashes, and miss long-term growth opportunities. He reminds us that while short-term setbacks are inevitable, the long-term trend of progress is overwhelmingly positive. Believing in optimism doesn't mean ignoring problems. It means trusting in humanity's ability to adapt and improve. Don't let fear dominate your financial decisions. Optimism, grounded in reality, wins over time. People don't just want facts. They want narratives that make sense of uncertainty. This is why bubbles form when a compelling story, like housing prices always go up, convinces masses of people to act irrationally. Housel emphasizes that we must be skeptical of too good to be true stories and constantly ask, does this narrative align with reality? Stories are powerful but dangerous. Stay critical and don't let excitement or fear cloud your judgment. Wealth is more about behavior than intelligence. Saving is more important than income. Avoid extreme risks and plan for uncertainty. Freedom and flexibility are the true measures of wealth. Financial success doesn't require genius. It requires humility, patience, and consistent behavior. Money success comes from mastering your behavior, not from knowing everything about economics or investing. Housel shares his personal approach to money. He admits he doesn't optimize every dollar for maximum return. Instead, he builds his financial plan around peace of mind, flexibility, and simplicity. He highlights that there's no single right way to manage money. It depends on your goals, values, and tolerance for uncertainty. Personal finance is personal. Build a system that works for you, even if it's not perfect on paper. Money is not just about numbers, it's about emotions, behavior, and perspective. Success comes not from chasing perfection, but from balancing optimism with realism, discipline with flexibility. Ultimately, money should serve you, not control you. Its greatest power is giving you the freedom to live life on your own terms. True wealth is a mindset. Manage your behavior, respect uncertainty, and use money as a tool for freedom and fulfillment. Thank you for joining us on today's episode. The Psychology of Money by Morgan Housel reminds us of a simple but powerful truth. Wealth is not just about what's in your bank account, it's about your mindset, your behavior, and the choices you make every single day. Remember, true financial success is built on patience, discipline, and humility. It's not about chasing quick wins or comparing yourself to others, but about creating a life of stability, freedom, and peace of mind. If today's episode sparked something inside you, don't just keep it to yourself. Hit subscribe, share this podcast with someone who needs a boost of inspiration, and most importantly, take action. Start putting these powerful principles into practice because the way you think about money doesn't just change your finances, it has the power to transform your entire life.